Federal Reserve is now on track to hike interest rates, it says, as soon as September. One doubtful critic of all this is Bill Gross. He warns that the Fed right now could actually be doing a whole lot more harm than good. I'm with you, Bill. Joining me right now exclusively, the man known around the world as the Bond King, Bill Gross of Janus Capital. Good to have you here.
Thank you, Trish. Nice to be here. Okay,
so the Fed, 6+ years, zero interest rates, multiple rounds of money printing via QE into the economy, and here we are, 2.3% growth. We don't have a whole lot to show for it. Is the Fed doing more harm, Bill, than good?
Well, I think as we continue, and we've been at 0% interest rates or near 0% interest rates for almost 6 years now, Trish, there is potential harm to a capitalistic economy, because when interest rates are that low, it introduces distortions into financial markets. It elevates stock prices, it elevates bond prices and lowers interest rates, and investors ultimately are searching for a P under the shell in terms of a shell game. They don't know exactly where the P is, and they don't know what the proper PE or the proper interest rate should be. And so ultimately, I think the Fed does have to try to normalize interest rates and bring them back to pre-Lehman types of levels, probably lower, but certainly not 0%.
Yeah. So do you fear that we're in that environment right now, as you talk about the distortions that investors put onto bonds and onto stocks? Is that what we're seeing?
Oh, for sure, and we're seeing it globally, are we not, in terms of China, in their stock market, as it moves up 100% in the first 6 months and then down 30 or 40% within the space of 1 or 2 weeks. We're seeing that in Euroland with the ECB having negative interest rates in many of their countries, and certainly we're seeing that in the United States with our 6-year near 0% interest rates. And so ultimately, Trish, capitalism depends on investment. And productivity depends upon that investment. And to the extent that markets are distorted, then the investment in the real economy, which is the most important and critical factor, becomes distorted and at risk. And so ultimately, I think the Fed gradually has to raise interest rates to give, if only savers, a break, relative to what they've gotten from their bank CD at close to 25 basis points for a long, long time.
I know, Bill, you think they have to. Do you think they will? And if so, when does it happen?
No, I don't think they will. I don't think the Fed really has embraced the notion that some have. For instance, the Bureau of International Settlements, that's sort of an esoteric institution, but it's the central bank of central bankers. In their annual report just recently, they suggested that the central bank should start to move interest rates higher to eliminate this type of distortion. Will the Fed do that? I don't think so. I think they're still stuck in the old method that suggests that the lower the interest rate, the better. And I think ultimately, when Bernanke went through 1% or through 2% down to the zero level and introduced QE, that the distortions began. I don't think the Fed has learned much or has embraced this new philosophy that the Bureau of International Settlements and others are advocating.